how does mortgage insurance actually work? So mortgage insurance, again, protects the lender in the event that you stop making payments, but the premium on that policy you pay for as the borrower. And the amount of the premium is based on the amount of your down payment. And so based on how much you're putting down, 5%, 10%, 15, or 20%, a premium is added to the mortgage. So here's a couple of examples for you. If you were going to put 5% down on a brand new property, your premium would be 3.15% of the mortgage amount. If you were going to be putting down 10%, your premium would be 2.4%. And if you were going to be putting down 15% on the purchase of a new home, your premium would be 1.8%. And you might say, great, Dylan, lots of percentages there, but can you translate that into some real math so that I can better understand it? Okay, let's say that you're looking to borrow $500,000. That's the mortgage amount that you're looking for. If you had 5% to put down, your mortgage premium would be $15,750. If you were looking to borrow $500,000 and your down payment was going to be 10% of whatever the purchase price was, then your premium would be $12,000. And if you were looking to put down 15% and get a $500,000 mortgage, your premium would be $9,000. So what does that mean? That amount of money, that premium, is added to the principal balance of your mortgage and then amortized over 25 years or 20 years, whatever the amortization is that you picked for your mortgage. So what does that mean? Well, that means if you added a $15,000 insurance premium to your mortgage, you end up paying interest on that premium through the entire amortization. So it does cost you more than just the amount that's being added to your mortgage. In fact, with the way mortgages are structured, basically the first half of the payments you make over, if you get a 25-year mortgage, the very first half of the payments are pretty much all interest, and you really don't start paying down a lot of principal until the second half of the mortgage, or until you pass the halfway mark. And so if you have a mortgage insurance premium added to your balance, that's just an additional amount of money that you end up paying interest on. And so there's a cost to getting mortgage insurance, certainly. There's a cost to not having enough of a down payment to purchase a home. And for some people, it's not a big deal. They say, well, you know, I'm very comfortable living in the city that I'm in, that the property values are going to increase, and I'll be able to make sure I can cover off that cost. But it's certainly something to think about. I was chatting with a client this week who was asking about mortgage insurance, and my comment was, well, if you don't need it, don't take it, because there's a cost to it. You do pay interest, and of course interest isn't money that you ever get back, and you don't necessarily realize any value out of it. And so if you need mortgage insurance, make sure you really need it and that you don't have a different way of putting the down payment together so that you can avoid that premium.